Welcome to the Strategy of the Week presentation for August 16th, 2013. My name is Todd Shaffer. I'm the Manager of Research for VectorVest, and I'll be providing your strategy presentation this evening. For the past several weeks of earnings season, I've heard and read a long list of analysts say they're looking for companies with good top-line growth. In other words, increasing sales. With the slow economy, worries about consumer demand, and ultimately worries about continued earnings growth, it makes sense to look for companies that are still selling more stuff. So, how would I find these companies? VectorVest, of course. VectorVest has sales data for each company, namely, our first parameter, sales, which is the annual sales for the company, sales growth, which is the sales growth rate in percent over the last 12 months, sales per share, annual sales divided by the outstanding shares, and finally the price to sales ratio, the ratio of price per share to sales per share. Each of these indicators can be found in our stock viewer. Let's take a look. From the home page, we'll go into the Viewers tab, and we'll choose Stock Viewer. And minimizing the viewer's window, if we scroll to the right, once you get past the dividend information, the open, high, low, close, volume, here's all of our sales information off on the right-hand side of the database. And here we see sales, sales growth, sales per share, price to sales ratio, total number of shares, and the market cap. And if you're ever in doubt, all you need to do again is right-click on the stock, view the full stock analysis report. It's laid out in the same organization, so you just scroll down to the sales and market cap information. And here you see a definition then for each of those indicators. So these are the primary sales-related indicators available to us, but to gain insight on how to use them effectively, I turn to the views in Dr. DeLito's past essays. Because I know there's nothing new under the sun, so what has VectorVest published in the past about top-line sales growth? Jumping back to the PowerPoint, I ran across a couple essays that I think were very helpful. The first was March 5th, 2010, Romancing the NPM, or the Net Profit Margin. March 12th, A Whole New Dimension, and March 19th, 2010, The Comeback Kids. Let's start by moving into the program, and we'll take a look at that essay from March 5. From the home page, we'll go up to the Views tab, open the Views Manager, and if I look at the essay viewer, this lists chronologically all of the essays that Dr. DeLito has written since 1995. Let's scroll down to 2010, and more specifically, March 5th, Romancing the NPM. I'll double-click it, and that'll bring up the essay. I came to this essay first because I think it sets up nicely our current situation and our strategy for this evening. And we'll pick it up in the second paragraph. Our goal was to continue to be the world's low-cost producer, and we worked very hard at it. But cost reduction alone wasn't enough to make a good profit. You also needed pricing power, which was impossible to get during a recession like we had in the early 80s. Not unlike our situation today, where we're fighting deflation. He continued, cost-cutting is king, and pricing power is nowhere in sight. Last quarter's profits are deemed to be good, but investors want to see sales growth because you can't cut costs forever. But hey, all businesses aren't commodity businesses. There are companies out there that make specialty products, have pricing power, and good profit margins. Who are they, and how do you find them? He then begins to compare this relationship between earnings per share and sales per share. And I'll scroll down a little. And he uses them to calculate a new parameter called the net profit margin, or the NPM. The next week he continued the series with an essay titled A Whole New Dimension. Clicking on that, we'll scroll down to the essay. And here's where I struck gold. He begins, net profit margin, NPM, which I introduced last week, shows the after-tax profit that a company makes in percent for each dollar of sales it receives. It directly relates bottom line and top line performance in one simple figure, and therefore is a wonderful measure of profitability. He then works through an example with Lazy Boy, but if we scroll down further, we're now discussing graphing the net profit margin. I simply check net profit margin and I can see the net profit margin goes up, right in concert with earnings per share. When I add sales growth to the graph, I can see that it too has gone up very nicely since last year. That's what I really like to see. Rising sales growth, rising earnings per share, and rising net profit margin. This creates the theoretical link for our strategy this week. If we can find companies who have positive sales growth and positive earnings growth, then you should have rising net profit margin. And this time, to find those profitable companies whose sales are still rising, we're going to use sales growth and earnings per share as our primary parameters. Let's move into the Unisearch tool. Clicking on Unisearch brings us into the Unisearch tool, and you'll find that we've added a new search in the net profit margin group. If we scroll down, in the net profit margin group, we now have a new search called Top Line Growers. If I click on it, we'll populate the search parameters, and I'll minimize our search window. The biggest difference between this search and Dr. DeLito's previous work was one of time frame. I, like the analyst, am interested in finding the companies who are still growing sales and earnings in the near term. I'd like to eliminate companies who were once on a positive growth track but have since started to wane. So first, I decided to focus on safe, established companies, which are currently in favor, by the way. So I narrowed my universe to stocks in the S&P 100 index. The companies in the S&P 100 are some of the largest, best established companies within the S&P 500. And in keeping with that theme of solid companies, we applied a sort that has the best combination of comfort index or price persistence and safety at the top of the list. Next, we made it Derby ready with average volume above 100,000 shares and a price above $1. And for the real heavy lifting of this search, we looked for stocks earnings who on a 13-week delta are above 0, so they're rising. We're also looking for sales growth delta over the past 13 weeks or the last quarter to be equal to or greater than 0. In other words, they're rising as well. Remember, delta measures the magnitude of change in an indicator over time, expressed as a percentage. So to recap, we're looking for companies whose earnings and sales growth are both rising over the past quarter. They're members of the S&P 100 watch list, and we're going to bring to the top of those candidates that meet the requirements the ones with the best combination of comfort index and relative safety. So let's run the search. And we can see this list reads like a who's who: Gilead Science, Starbucks, Lowe's, MasterCard, Union Pacific, household names, household brands. Here's their CI times RT value, which was our sort. But look at the 13-week delta on earnings here. Earnings up anywhere from, just in this first page, anywhere from about 2% all the way up to 20%. The 13-week or last quarter's sales growth, anywhere from flat for United Technologies all the way up to 300% for Honeywell. And if we scroll to the right, some very solid fundamentals in these companies, although not all are in uptrends currently. And finally, look at some of those CI ratings. Very nice numbers. We always look at a graph, so let's take a look at the top 10. Here's our first graph for Gilead Science, and before we move ahead, let's just lay out the graph. We're looking at a 3-month window now, that 13-week look-back period. On the top graph, we have the price of the stock, then the earnings per share, and sales growth. And what our parameters were looking for was that the earnings per share is lower 13 weeks ago than it is today. Looking at price action, yes, Gilead Science is in a downtrend right now. Remember, our market peaked here around the 5th. And so this is just another reminder, if we want to buy rising stocks and rising markets, that the market trend really does trump everything, because it can beat up good stocks just as well as bad. Hopefully these stocks, with their high relative safety and high CI numbers, will be a little more resistant to those downdrafts. But let's just scroll through these graphs and see if generally we're finding what we asked for with positive deltas of both earnings and sales growth. Starbucks, yes we are. Lowe's, yes we are. MasterCard, yes we are. United Technologies, sales growth stayed flat from its previous quarter, so it still qualifies. You can see we see some very nice chart patterns for both earnings and sales growth. So the next step I want to take, instead of running that search on the first day of a confirmed down call, I want to see how it performed over the last several market turns. Let's go to our market timing graph. Here I have a 1-year market timing graph, and this is a good period for me because I want it to be fairly recent and I can see how it works in this QE2 environment. So for my first pass, I'll use this 1-year time frame, actually starting at the beginning of 2012, so I guess a little more than a year, more like a year and a half, I guess. And I'm going to use what I consider to be our best market timing system, the RT Kicker combo. But we're going to use a technique that we demonstrated in a strategy of the week back in May called staying long for the long run. And what we'll do is we'll buy positions on the green arrows, but we'll hold the positions on stops through the red and the yellow signals. So we'll buy into the uptrends, we'll coast through the downtrends, never going to cash, buy on the uptrends, and coast through some of these little short reversals that happen and try to ride out some of these pullbacks and corrections in the solid stocks that we have with these high CI, high safety values. So to do that, let's move into the backtester. We'll click on Backtest an Idea, and we'll use our default account settings, which have a $100,000 initial investment and a $9.95 per trade commission load. For our market timing signal, because we do have the auto tester plugin module activated here, I can automatically load in the market timing signals. If you don't have this feature, it is available for a 2-week trial. You can sign up for that trial by using the link in the VectorVest views or call us in product support. But if you take advantage of that trial, you can save $100 off on the purchase by doing that this week, and the purchase price is only $3.95 instead of $4.95. Of course, those with a real-time subscription would have this activated as part of your base subscription. And of course, these results can be accomplished without the auto tester. You just need to go point to point for each market timing signal. With that being said, I'm going to click on that tab, which will take me over to the market timing wizard, and we're going to change from the confirmed calls to the RT Kicker combo. The RT Kicker combo has 3 signals that it generates. An up signal are given when a green light is confirmed in the color guard with the RT moving average. The down signal is given when a red light is confirmed by the RT moving average. And a neutral signal is given any other time. So for each of these situations, we have a set of rules that we need to make. So for the up situation, we're going to buy long. And we're going to use our new search by scrolling down to the net profit margin group. We'll click on top line growers. For our stop criteria, we're going to use a percentage gain loss of a 50% gain and a 20% loss. Using intraday stops, we'll go to the more settings tab and we'll use 5 positions. We will automatically replace closed positions. We'll open all 5 at once. We don't want to close any open position every time we get a green light. So we're going to select don't close any open positions. If we scroll down further, we'll invest our average portfolio value in each position, buying odd lots. We're going to limit our repurchases to 31 days for the wash rule. And we're going to say the maximum stocks per industry. We're going to check that and make that be 3. And the maximum percent of a stock's average volume will be 2. Of course, you can change any of these settings and study their effect on your own software. Moving ahead to the automation rules for down, we're going to take no action, which means we're just going to let those open positions ride out their stops. And the same is true for the neutral signals. Our test period, we'll roll this back to the beginning of 2012. And I'll select the last day of December of 2011. And for our end date, I like to go Friday to Friday, so we'll choose the 9th. And we'll give this a name, and let's call it Top Line Growers 50/20 for a 50 gain, 20 loss, documenting what we're doing in the portfolio. And then finally, I'll click Finish and Run. Let's take a look at our results. We'll begin with our performance line. Here we see the dates and settings for the portfolio. We had 100% winning trades with a total gain of 34.8%. Our commission load 69.65, which means we had 7 trades, which means one stock stopped out and was replaced. That made an average annual return of 21.62% with a maximum drawdown of 9.5%. Looking at our equity curve, it did struggle a little bit underwater here in the first month or so of the portfolio performance. And we did pull back here a little bit. Remember the April and October downturns in the market in 2012. So we did suffer some drawdown, but again, less than that 9.5%, so not too bad. And we are hitting a series of continuous higher highs. So all in all, very favorable performance. And one of the things that I like about this is if we look at the holdings that are currently in the portfolio on the precipice of a confirmed down call, Nike, Colgate, Abbott Labs, Philip Morris, Gilead Science, double-digit gains in all but the last. And of course, if you want to hold on to them, you could protect them by hedging them as well. So nice results in the short term. Next, I want to ramp it up, and we're going to strike a copy of this back test. And we're going to leave all the settings the same, except we're going to change our test period. And this time we're going to go all the way back to the beginning of 2010. So if I click on January, I'll again start on the 31st of December. And we'll bring it through last Friday. And we'll give this a name. And we'll leave it the same. We'll just say 2010 as our starting point. And we'll click Finish and Run. And here, thanks to the magic of time-lapse photography, are our results. Let's begin our analysis with our performance metrics. And remember, this was just a random start date. We picked the first trading day of January of 2010 as our start point and just picked it up midstream with our next trading signal. Overall, we had an 89 1/3% gain with 68% winners. A total commission of $328.35. That's a total of 33 trades over about 3.5 years. The average annualized rate of return was 24.7%. Our maximum drawdown up to 18.13%. That drawdown hitting us, if we look at the equity curve early on in the portfolio, if you remember, the January and the summer markets of 2010 were dramatically difficult. And of course, we entered this midstream. We were in an uptrend that began in November. So while these stocks may be resilient, they're not impervious. So I might consider taking additional steps to protecting the portfolio in these difficult market periods. Nevertheless, let's look at the equity curve in terms of its volatility and the fact that it keeps hitting higher highs time and time again. Again, if we look at our current holdings, Costco, McDonald's, CVS, Gilead Science, Union Pacific, looking at their current return, we've got a 40% gain, 37, 32, 7, 1.5. But notice when they were added to the portfolio. I still have McDonald's, which we bought in July of 2010, Costco from October of 2011, CVS from February of 2012. And of course, something we haven't even considered is if I look at the watch list view, scroll over to the dividend analysis, I do have some nice paying yields on some of these stocks. So hopefully we've laid a solid foundation for you. And of course, we encourage and invite you to do your own analysis. Try your own different stop criteria. Try some modifications of the search to make it more suited for you. Try some of our other market timers. In any event, you have all the tools you need to make this strategy one of your own. If you have any further questions about this strategy or any of the powerful tools within the VectorVest system, please give us a call at our 800 number 888-658-7638. Our product support staff would be happy to help. Of course, you can always come back to the VectorVest University for our historical presentations. And I would encourage you also to join us on Monday for our live webinar doing Q&A on this specific strategy presentation. You can register and link up for that presentation in the views. With that, I'll say goodnight. Have a great weekend.